ETFs versus mutual funds. What's the difference? If you're planning for retirement, one decision can quietly shape your financial for decades to come. Whether to use ETFs or mutual funds in your portfolio. For years, mutual funds were the go-to option for most investors, but now ETFs have exploded in popularity, and for good reason. They're often praised for being more cost-effective, more tax-efficient, and more flexible. So which is the smarter choice for someone approaching retirement? And could choosing the wrong one cost you unnecessary fees or even trigger taxes you didn't expect? The truth is, neither ETFs nor mutual funds are inherently better. They're simply different tools, and understanding how they work can help you avoid costly mistakes and build a retirement portfolio designed for stability and growth. Hi, I'm Josh Bliss, financial advisor and founder of Gateway Capital Management, now proudly under Balboa Wealth Partners. And today, we're recording from beautiful Montana. We help successful retirees and pre-retirees simplify their investments, minimize taxes, and create a plan for lifetime income. And in this video, we're going to unpack the real differences between ETFs and mutual funds, so you can understand which option may fit best in your retirement strategy. Before we dive in, make sure to like this video, subscribe to the channel, and drop a comment below about which one you've used in your portfolio. 1. What are mutual funds and ETFs? Let's start with the basics, because understanding the foundation will make the differences much clearer. A mutual fund is a professionally managed investment vehicle that pools money from thousands of investors and uses it to buy a diversified mix of assets, stocks, bonds, or a combination of both. You don't buy them on the stock market. Instead, you purchase shares directly from the fund company. Here's the catch. Mutual funds are priced only once per day after the market closes. So if you place an order at 11 a.m., you won't know the price you're getting until later that evening. On the other hand, an ETF or an exchange-traded fund works a little differently. Like a mutual fund, an ETF gives you exposure to a basket of investments. But ETFs trade on stock exchanges throughout the day, just like individual stocks. This means you can buy or sell an ETF at any point while the market is open, and the price can change minute by minute. Think of it like this. A mutual fund is like ordering from a restaurant with a set menu and only one serving time per day. An ETF is like a food market where you can walk in anytime, browse, and decide on the spot. At their core, both are designed to help you diversify your investments without having to pick individual stocks or bonds yourself. But that's where the similarities end. 2. Key differences that matter. Here's where mutual funds and ETFs really start to diverge, and why the right choice for you depends on your goal. How you buy and sell. Mutual funds are purchased directly from the fund company at the end of the day price. There's no trading during market hours, and you don't know exactly what price you'll get until the market closes. ETFs, however, trade throughout the day, like stocks. You can set specific prices, use limit orders, or react to market movements in real time. For long-term retirement investors, this difference often doesn't matter much. You're not day trading anyway. But if you value flexibility or want more control over your trades, ETFs have an edge. Costs and fees. This is one of the biggest reasons investors switch to ETFs. Many mutual funds, especially actively managed ones, carry higher expense ratios. Some also come with front-end or back-end sales charges known as loads and minimum investment requirements that could be as high as $50,000. ETFs generally have lower expense ratios, and most brokerages now offer commission-free ETF trades. To illustrate, a mutual fund might have an expense ratio of 0.50% or 0.5%. A comparable ETF might cost just 0.05%. On a $500,000 portfolio, that difference alone could mean saving over $2,000 per year in fees. Over 10 to 20 years, that adds up. But not all ETFs are cheap, and not all mutual funds are expensive. You have to look under the hood. Tax efficiency. This is especially important for retirees with taxable brokerage accounts. ETFs tend to be more tax efficient because of their in-kind creation and redemption process. They rarely distribute capital gains, meaning you have more control over when you pay taxes. Mutual funds, by contrast, pass along capital gains taxes to shareholders at year end, even if you didn't sell a single share. Imagine this. You've held a mutual fund all year, but the manager made several trades within the fund. Come tax time, you get a surprise capital gains distribution, and now you own taxes on gains you never realized yourself. This doesn't happen nearly as often with ETFs. Active versus passive management. Most mutual funds are actively managed with a team of professionals picking stocks and bonds they believe will outperform the market. Most ETFs are passively managed and track an index like the S&P 500 or the NASDAQ. They don't try to beat the market, they aim to match it at a very low cost. If you want professional management and you're comfortable paying for it, mutual funds may appeal to you. If you want a low-cost, set-it-and-forget-it strategy, ETFs might be a better fit. 3. Pros and cons of each. Mutual fund pros. Access to active management and professional expertise. Ideal for automatic contributions or withdrawals, which is helpful if you're drawing monthly retirement income. No need to think about daily price fluctuations. Mutual fund cons. Higher fees on average, less tax efficient and taxable accounts, and may include sales charge or high and minimum investments. ETF pros. Lower costs on average, tax efficient structure, which is great for taxable accounts, flexibility to trade anytime during market hours. ETF cons. Requires a brokerage account to trade, no built-in automatic investment plans unless offered by your broker. Intraday trading may tempt some investors to overmanage their portfolio. 4. Real-world example, Bob and Susan. To make this more tangible, let's look at Bob and Susan, a couple in their mid-60s who just retired. They have $2 million in investments. $1.5 million is in their IRAs. $500,000 is in a taxable brokerage account. In their IRAs, Bob and Susan use actively managed mutual funds. They like the idea of having a professional team navigating markets ups and downs. Plus, since IRAs are tax-deferred, they don't have to worry about annual capital gains distributions. In their taxable brokerage account, they've chosen ETFs. The lower expense ratios and tax-efficient structure means fewer surprise tax bills, and more of their money stays invested for growth. This blended approach gives them the best of both worlds, simplicity and professional management where they need it, and tax efficiency where it matters most. 5. Which one should you use? There's no one-size-fits-all answer. It depends on your goals, your accounts, and your preferences. If you're investing through a 401k or IRA, you're often limited to mutual funds anyway. And tax efficiency doesn't matter because those accounts are tax sheltered. If you're investing in a taxable account, ETFs could help reduce your annual tax bill. If you value simplicity and want to automate contributions or withdrawals, mutual funds might be a better fit. If you value flexibility and want more control, ETFs are worth considering. And you don't have to choose just one. Many retirees use mutual funds and tax-advantaged accounts, and ETFs and taxable accounts to balance convenience and tax efficiency. This is where working with a financial professional can make a big difference. So there you have it. ETFs and mutual funds both have strengths and weaknesses. The right choice depends on your goals, your accounts, and how you want to manage your investments. If you're approaching retirement and want to make sure your portfolio is working for you, not against you, let's talk. Click the link in the description below to book a free consultation, and I'll walk you through your options. Thanks for watching, and if you found this helpful, don't forget to like this video, subscribe to the channel, and share it with someone who's planning for retirement.